Welcome back. This is not financial advice, and in today's episode, we're going to be taking a look at Clorox, the company, and its stock ticker symbol CLX, one that recently came on my radar by way of Morningstar, which is a really great research firm that has a YouTube channel and a website that I used to use before they put a paywall in front of their data. So today we are starting off on our review of Clorox stock over on Qualtrim.com. It's a suite of software that I do pay for, but I have no affiliation with. So thanks to Qualtrim for this data, and I will put a link to this software in the description below. So, Clorox, what do we know about it? Clorox, word association game, Clorox, bleach. Um, Looked into it. Seems like they are about a 110-year-old company, 105-year-old company. And I discovered some different products that they offer that I was really shocked by. Looking at the thumbnail, you've got an idea. So we're going to talk about that more in a second. But let's look at the price of the stock, and then we're going to get a better idea of what the value might be. So currently, shares are trading for $122. And if we look at just sort of a rough trend line, there might be an indication that shares are currently undervalued, but I'm not so sure about that. So we need to discuss. And we're going to use Qualtrim not to look at the price of the stock, which is $122, but to try and get a better sense about what is the intrinsic value of shares in this company. So starting at the top, let's run through some ratios or metrics that are helpful. So this is uh, what I would describe as a large cap value company. It's a little bit of a smaller market capitalization. Um, and at the same time, there are some different elements. It's historically traded at a premium because it's seen as a pretty safe brand. So it's traded at a high PE ratio. So it might be more of a smaller, large cap blend. Now it sounds like I'm describing coffee, but this is the stock that we're looking at. Forward PE ratio of 36, which is a lot. Stock-based compensation adjusted free cash flow yield. That means for every $100 that comes into their company, $5.60 is profit that can be dispersed to shareholders, people like you and me, as well as members of their board and other people who own Clorox shares. So a great um, free cash flow yield. Um, But when it gets too much higher than this, it might be that people aren't seeing a lot of growth in the future. Anyway, we'll get to that in a second. So, cash on hand, $367 million. Debt, a little bit high, $2.4 billion. This is going to be, I believe, a dividend aristocrat. I think that this stock has increased its dividend every quarter for 25 years. Don't quote me on it, but this is certainly company that has a really strong record with its a track record with its dividend, and so that's going to be part of how we're looking at its value here at the end of the video. But a very high starting yield of 3.9%, and they've had some problems with earnings per share recently, which has led to a pretty significant drawdown in the price of what had been considered a safe haven, defensive, low volatility stock. We're going to talk about that too here as we move forward. So the payout ratio currently is unsustainable, but that should come back under control as earnings and free cash flow rebound. So, uh, speaking of all of these things, let's take a look at the revenue on the company. So it's going up into the right. It's a 105-year-old company. So I'm seeing a lot of growth in the last 5 years, closer to 4%. That's going to be related to the pandemic. People buying bleach and Clorox wipes to disinfect their home and offices and things like that. And so that is likely a little bit artificial. And it also would have something to do maybe with supply, demand, inflation, things of that nature. But I think the best way to look at this growth on the company is at 2.77% on average over the last 10 years. but the company is not getting any younger. So we're going to base our DCF valuation off of this number. So remember, 2.77% annualized growth on average over the last 10 years. It's going to be something handy that'll come in useful later. Let's take a look at the free cash flow. This is the best way to look at it. Make sure we're on annual. We are. So free cash flow of the company. I've removed stock-based compensation thanks to Qualtrim. That gives us a more accurate representation of what's going on in the business. So let's pick a date. Let's go back to 2000. So we can see in 2000, they had $500 million of free cash flow. 23 years later, they had almost $860 million of free cash flow. So it's slow and steady up and to the right. There is some cyclicality, but overall, this free cash flow chart looks pretty dang good, I would say. So let's also take a look at other things that matter. Right here is a snapshot of the debt and cash position on the company. So higher debt than cash, not by a little, by a lot. They have a lot of debt. I'm sure their credit rating is at least as good as the federal government's. So not overly concerned. Let's take a peek at the dividend. So they grow it pretty steadily. We're going to use this number later too. Looking at some of the problems they had with earnings and the last 3.5 years, which hopefully are an event that isn't repeated. I'm looking at the dividend growth of this company to be somewhere between this 4.5 and 5.5 number. And so that's the dividend growth rate. Over the last 5 years, it's been an average of 5.39% annual increases in dividend yield. So dividend yield has been beating inflation on average over the last 10 years. Not by a little, over the last 10 years, by a lot, outpacing inflation by a lot. So let's also look at other things that matter. We love companies that buy back shares. This company does that. So a share you buy today, if the trend continues, you'll own a bigger piece of the pie tomorrow. Importantly, let's look at return on capital employed. Super duper high. The average is well over 20% over the last 5 years. So excellent allocators of capital. Exemplary was the word I was searching for. Looking at historical PE valuation, this company tends to trade around a 28, 20, 22 to 25 to 28 PE. So it typically trades pretty high. Right now, this is off because they had a reduction in earnings per share, which should normalize, and I'll explain that. But yeah, I think that gives us a pretty good overview of the company. Revenue is slow and steady up and to the right. Free cash flow looks pretty good. Let's take a just look at earnings per share, which isn't a metric we use all the time. But what we saw through here is when we started to see a drawdown in the price of the stock, and we're going to move to that right now. So, this company had a big. Let's look at the beginning, the outbreak of COVID, the beginning of the market crash. So that would have been on about March 31st of 2020. So as the market was going down, Clorox understandably went up about a third, 33%. So there's a lot of artificial pull forward of demand for this company's stock. They've had some issues. Not sure exactly where it happened. It may have happened right around here. But as people realized that people were going to be doing less and less obsessive cleaning, the company traded down. And there were some big drop offs recently, and it's just dropping off a cliff. But if we look at the stock price of this company, it is down 49% from all time highs, which is a lot. And that's taken about 3.5 years to get there. But as you can see, the stock is down 49% from all-time highs. Let's zoom out a little bit. And so we can just sort of see that trend line of the company again. See the trend line of the company. It's fallen off a cliff. And we're going to look here and we'll just see. This will be a little bit harder to do, but we'll just see the stock's down about 49%. So cut in half in 3.5 years. So is this an interesting point to enter the company? Let's make sure that we know what we're talking about. So what products do they make? So not sure what this is. I think this might be I do know that a good chunk of their revenue comes from overseas. Just off the top of my head, don't quote me, somewhere around 20 or 30%. So this looks to be a Latin branded version of Clorox. But then, of course, we have their flagship namesake, Clorox, bleach, scented, by the gallon wipes, Clorox Pro. So they have some exposure probably to the medical space. Some other brand people don't care about. Liquid Plumber, Pine Sol is a big name. No one cares about that. So those are the cleaning products that they offer. Now I found this to be super interesting. Brita water filters. I've got some of those. So that's really cool. Fresh Step. That's one of the bigger names in kitty litter. I've always been interested in products for pets. I think that Americans view pets like children, and if people stop prioritizing the care of their pets, the stock market doesn't matter anymore. So they have a small amount of their exposure from this area, but I love seeing that product mix in there. Glad, so the number one, again, a lot of these things, Pine Sol, Clorox, Fresh Step, Glad, they're number one or number two in their categories. So the question is Clorox the best consumer defensive stock on the market? Jackpot. These people own ranch dressing. Hidden Valley Ranch is owned by Clorox. Who knew? I'm a fan. I'm from Iowa. We put that on everything. Um, Sometimes even when we have cookouts. So they also own Kingsford charcoal for grilling and barbecuing. That's awesome. So really interesting products. Most people wouldn't know. I didn't know until just the other day. So I wanted to bring that to you. Interestingly, they also own Burt's Bees, a really nice, sort of more natural or organic chapstick. And then they own a bunch of other vitamins and supplements that I don't recognize and I don't think matter or people care about. So that's who Clorox is as far as what they offer. Now we have all of our inputs and our data from Qualtrum that we're going to be using to do our valuations on. But I want to come over here and explain to you what happened with the drop off in their share price, their earnings per share, and their free cash flow. So over here at Morningstar, Clorox, cybersecurity breach strangled results, but shares still a bargain. That's their opinion. Um, from this analyst named Aaron. So earlier this month, they issued first quarter results. They were bad. Um, and that reflects that the company's operations were shackled by a cybersecurity breach in August, so just several months ago. So the decline happened because people were purchasing less disinfecting products for their home in the last 18 months or whatever, which is somewhat understandable. But then a double whammy, the cybersecurity breach in August. So that's where those two sharp drop offs occurred. Are likely based on earnings that were lower in the past, maybe 18 months or a year ago, and then the cybersecurity breach. So this might also lead us to ask the question if it would be an interesting investment to be exposed to the cybersecurity industry or subsector, maybe via an ETF or an individual company. But I'm sure they're priced pretty richly. But cybersecurity, it seems to be an issue that's affecting a lot of companies right now. So that's what happened with that. And we're going to go over the last thing here in this review of the stock. We're just going to take a quick look at a screen shot on this company. So Morningstar, people who I think are really smart, they say that the stock is worth $168. Spoiler alert, that's not what I came up with. So it's really making me scratch my head. I did verify my data over from Qualtrim. I verified it with Yahoo Finance, and I found that the data from Qualtrim was accurate. And so we're going to get to that in a second. But with those brands that we saw, Ranch, Kingford Charcoal, Fresh Step Kitty Litter, Pine Sol, Clorox, Burt's Bees, the economic moat of Clorox is certainly wide. It's viewed as that safe haven defensive stock, and that's why it's traded at such a premium for so long, with relatively slow but steady, but relatively muted revenue and free cash flow growth here. So it is noted, the word I was looking for, exemplary capital allocation. So that return on invested capital well above 20% means that these people know how to take debt and equity and turn it into free cash flow. So that is certainly worth a premium. Their profitability ratios, as well as their wide economic moat, that's a double premium, and that's why this stock trades at such a high valuation, as well as the dividend yield. So their status as a dividend aristocrat, I do believe. At this point, dividend yield's even a bit higher than this, but over 3%, closer to 3.5%. So we sort of can see here maybe three reasons why the stock is always traded at such a premium. The risk is viewed in uncertainty terms as medium, which means that cybersecurity is a thing. Corporations have ways to figure it out and get around it. But Morningstar considered these shares to be at a pretty significant discount. And I think that as I'm reflecting on this now, their capital allocation, their moat, and the low uncertainty of the business, as well as the dividend, I think that does justify a higher valuation. But let's look at some of the numbers that I came up with. Um, and I did value the company both with a discounted cash flow valuation, because they have plenty of that, um, but also on a dividend discount model as well. So let's take a look over here on this handy dandy little stock valuing calculator that I utilize. Average free cash flow over the last 5 years is $843 plus million of free cash flow a year. Pretty great. Cash on hand, 367 million. A good amount of debt, 2.4 billion. Shares outstanding, 124 million point two shares outstanding. Remember, and you could even go back, but I think their 10-year growth rate was somewhere around 2.77%. So these are the projections or assumptions I've put in for growth. In the next 5 years, 2.5%, down to 2% in the next 10 years, and then a terminal growth rate of 1.75%. Might be low, but it's a 105-year-old company. So I did a discount rate of 10%. Let's take a quick look at the price of the stock to remind ourselves. Stock is currently trading at $122. It's down over the last 5 years, down 50% from all-time highs, up a lot since whenever. But stock price 122, fair value based on my assumptions, $71. $71 is what I come up with. That's, when I had such a discrepancy between the stock price, the value I could come up with, as an amateur, um, as an investor who's learning and growing along with all of you, when I saw such a difference in the stock price, it really made me scratch my head. So I double checked the figures from Qualtrim on Yahoo Finance. But looking back on Morningstar, I think the dividend, the high return on capital, and the wide moat justify a bit of a premium. So it might be appropriate in this case to lower the discount rate to, let's just throw 6 in there. um, and in that case, maybe that's sort of where they're at. It's showing that the stock would be undervalued. If you put a premium on all of those three things, almost intangible in a sense, wrapped up in this brand, it could be it could be undervalued. I don't like that though. I think that's too much. The 5-year treasury, I think has a 5% yield today. So I'll do 7.5. So the risk-free rate of 5% on the treasury plus 2.5% for this volatility we can see in the stock might be worth around $110, $109 on a cash flow basis. So let's real quick run through a basic dividend discount. Hope you're enjoying the video. Go ahead and hit like and subscribe if you haven't already. Dang, should have asked you to do that earlier. If you're still here, you're a real one. I appreciate you. So, dividends per year, $4.80. We looked earlier at the growth rate of that dividend. I put in 4.25. Let's take a look at the let's take a look at the value of the stock based on dividends. I'm inputting a 4.425% estimated growth rate on the dividend. Um, and for rate of return, we'll do 10%. On those assumptions, I came up with a similar valuation as I did on my initial valuation for the free cash flow at 87. Um, so based on a more margin of safety or a higher rate of return, the stock seems to be worth somewhere around $80. I'm thinking that that might be a bit low. So let's go ahead and drop this down to a 7.5 and see what we come up with. And in fact, it does come back closer, very, very similar, in fact, to the valuation we had when we utilized free cash flow, but with a lower required rate of return. So 5% for a treasury and 2.5% risk premium actually brings me in line with the value that Morningstar is estimating. So I feel pretty cool and happy about that. Hope you enjoyed the video. Like and subscribe, and I will see you on the next one.